right, cool. We are started. Today, I brought my big brother David on. He is not just here for nepotism. He is a lender that we use frequently. A lot of you guys have met him. I just wanted to get some reads on the mortgage rates and a couple of questions answered on what's going on. So I wanted
Sure.
to jump right into this, David, if you want to introduce yourself.
Yeah. Hey, again, I'm David Bridges. Couple required disclosures. I got to let you know my NMLS ID is 222490, and I'm with First Heritage Mortgage. You can see up in the top there. Look forward to kind of answering some questions and getting you some general knowledge today.
That's how he introduced himself to my wife when he met her the first time.
I gave her my NMLS ID. Yes.
So, David, how long you been in doing this? It's been a
I'm
while.
in my 19th year of being a loan officer,
Huh?
and I actually just had 11 years at First Heritage. So I've been with First Heritage for quite a while. It's an amazing company, amazing management team, and I've just been very blessed to be here.
Yeah. And you grew up in Woodbridge. How familiar with the area are you?
Yeah, born in Fairfax Hospital, like you were actually. Graduated from Woodbridge High School. I definitely know the Northern Virginia, DC metro area. It's my stomping grounds. I've owned many, many homes in the area, investments in homes that I lived in and raised my children in. And I definitely know it and have been blessed to help clients literally finance billion-dollar plus worth of loans in real estate, and almost all of it's in Northern Virginia. I do lend in Pennsylvania, Delaware, kind of all the way south down to Florida, and then a couple other states like Alabama and Tennessee and West Virginia. But kind of that whole southeast area is area that I work with.
Wow. That's some bragging rights. All right, well, let's jump into it, man.
Sure.
We a lot of people are asking me about rates.
Yeah.
If I had
Yeah.
to ask, I mean, of course you know, but the current interest rates and where we are
Sure.
as far as historically speaking.
So let me kind of do an intro to what like interest rates are first, just to
Sure.
make sure everybody understands, and then I can kind of answer that question. So there is no interest rate. So interest rates are going to differ depending on the type of loan you're doing and the individual features of a borrower, like their FICO score, how much they're putting down, things like that. So what I do is I kind of talk about what's going on with the market, because if the market's improving for interest rates, then everyone's interest rates are improving. If the market's worsening, everybody's interest rates are worsening. So it's all relative. So let's talk about what's going on with the market rates
Mm,
and what they've done historically. So first off, most people who are looking to buy right now are coming into it after the past couple of years where we had significantly lower than market interest rates, which were basically created by some extreme measures that the Federal Reserve and the federal government put into place. Basically, under COVID, they just tried to keep interest rates as absolutely low as possible to make borrowing costs for
mm,
businesses as low as possible to keep everyone afloat during COVID. So for the last couple of years, we basically have been looking at something that wasn't real. It was real for a very short period of time,
mm.
and people who got to take advantage of it are really, really blessed. Um, but I don't think any of us want to go through that COVID experience again of getting lockdowns and all that to just have artificially low interest rates. So, kind of taking that out of the picture and looking historically, going back further, a decade, 2 decades, 3 decades, we see that interest rates kind of on average in the 6-7% range
Mm.
over time. Okay. So that is kind of where I target your market rate, kind of an equilibrium where it's a good interest rate where it's not too high that it stifles buyers, but it's also not too low that it makes too many buyers relative to the supply of homes, which artificially would inflate home values. So what we see now is that we see since COVID, we basically see the rubber band sling pullback from interest rates where they basically started jumping up. And the reason they were jumping up was because of inflation. So all that spending that the Federal Reserve and the federal government put out, basically all those dollars were chasing a very few number of goods. And because of that, that basically made things skyrocket in cost.
Mm.
And what you have to understand from a mortgage perspective is that if I'm going to lend you money and you're going to pay me back over 30 years, I've got to charge you an interest rate that ensures that I make money over those 30 years. Well, inflation is basically the devaluation of that money. It means my money's worth less in the future. So if I know that inflation's going up and now the money that I lend to you is going to be worth less in 30 years, I got to charge you more interest now to make more money over time to account for that inflation. So inflation going up basically forced interest rates to go up in the long term. So your 10-year, 20-year, 30-year mortgages all went up because of inflation. So now what we're seeing is that inflation's starting to peak. Almost all of the recent inflation reports, market reports, everything that's been putting out is showing this peaking of inflation, and it's going to start to have a little bit of a downward trend. And as that happens, interest rates are also going to pull back. So my professional feeling is I think we're kind of peaking in where interest rates are right now. And I expect to see lower interest rates really in the near to not too distant future.
Is it so? Besides inflation, is there anything else that goes into the way the government, I guess, adjusts these rates for the banks?
Sure, great question. So first off, there are a lot of different interest rates. Okay. The banks actually borrow money every night, and they borrow money and lend money overnight or for very short-term periods of time, and those are a particular interest rates. There's prime rate, there's LIBOR, there's all these different interest rates. So what our clients really care about are mortgage rates. And mortgage rates are 30-year rates or less that are set by mortgage-backed securities. They're not set by the government. They're set by the buying and selling of these mortgage-backed securities. So what happens is when somebody comes to me and they get a mortgage, I take that mortgage and I combine it with a whole bunch of other mortgages that are similar to that mortgage, and then I chop them up into tiny pieces and I sell them on the mortgage-backed security market. And what this does is this makes investors happy because instead of them owning one person's mortgage, which might go into default or might not, they own little bits of a whole lot of people's mortgages. So if one or two people have problems, it doesn't hurt them as much, and it basically spreads the risk out. But also what it does is it provides what's called liquidity, which is more assets, cash, for us to be able to lend out, making the cost of that borrowing go down significantly for borrowers. So that said, when these mortgage-backed securities get traded, just like stocks on the stock market. So pick a stock, say Apple. If more people are buying Apple stock and there's a demand increase for Apple stock, the price of Apple stock goes up. If people start selling Apple stock, that price goes down. So that's the same thing that happens with mortgage-backed securities. So when more people are demanding and buying those mortgage-backed securities because they think they're a very good investment and they're a great place to put their money, then the value of those mortgage-backed securities goes up, which means I make more money on those mortgages, which means I can charge a lower interest rate to get the same mortgage, to make the same amount of money. So when mortgage-backed securities, there's a higher demand for it, the underlying interest rates are going down. When people are selling those mortgage-backed securities because they think inflation is going up and they're going to be worth less, then that's what interest rates go up. So that is actually what's changing interest rates for people. It's that buying and selling. It's not necessarily the federal government or the Fed coming out in there and saying, we're raising rates, we're lowering rates. Because frankly, as the Fed has been raising rates, they have actually been trying to curb inflation, which has been good for interest rates. So what the Fed's been doing by raising short-term interest rates is actually good for the long-term interest rates. Now, eventually, if more things become more expensive to borrow, what's going to happen is the economy is going to contract. It's going to shrink because it's going to cost more to borrow. So you're not going to have as much money to pay your employees. You're not going to be able to buy as many goods to keep your company afloat. And that's going to cause interest rates to decline because of that reason. There'll be less inflation.
When someone comes in for approval for a loan, is this going to affect their approvals? And what way would that happen?
So the one single thing I try to get people to realize when they're buying a house and getting a mortgage is, and it sounds kind of funny, but you're marrying the house. You're going to be in this house a long time, but you're just dating the mortgage. If rates come down, you refinance and you get a better mortgage. you're not, just because you get a mortgage does not mean you're stuck with this mortgage for 30 years. When you buy a house, you're stuck with it unless you sell it and find another house, which is much more complicated to do than just coming to me and doing a simple refinance. So what people need to do is they need to kind of say, okay, is this mortgage affordable to me? Can I afford this to purchase the home that I want? And if they can utilize their mortgage as a stepping stone to be able to purchase the home and get into the home that they want and they want their family to live
Mhm.
in, they can always refinance it in the future and get a better mortgage payment, a different mortgage program, something that may be more affordable as their income grows. Because most people, their income is going to grow over time unless they're at the latter part of their careers, which that's a different mortgage strategy. So what I do with them is I try to establish what their goals are and kind of pair that with recommendations for different mortgage products and different strategies to get them the best mortgage that's going to meet their goals. And doing that is why I look at my role as not just a loan officer, it's more of a financial advisor that I'm specializing in real estate.
Okay. So someone who comes in and they get pre-approved, I mean, you go over rates with them, you go over
Yep.
like the importance of the process. A lot of factors go into qualifying, I understand. But is there any way to kind of give an idea of like what it looks like to kind of
Mm-hmm.
pre-approve with you, to get approved with you? And
Sure,
then
absolutely.
I mean, based on people's specific needs. I know you have different programs available to them. Do
Mm-hmm.
you have like, hey, here's some of the common things I run into?
Oh yeah, sure. So the pre-approval, or what I call the conditional approval process, I mean, we have a whole process that we go through with people. So it kind of usually starts with a referral. So you as a real estate agent say, hey, you need to talk to a lender if you're going to buy a home. Give David and his team a call. So they reach out to me. We usually have an initial consultation that kind of talks high level, the process, answers some general questions, maybe talks a little bit about things that they're concerned about, like interest rates, like some of the stuff we
Mhm.
just talked about. They ask a lot of questions and we give a lot of good answers. Then they actually do the formal application on my website, davidbridges.com. They go through that application. Then my team and I, we start the full analysis. We're looking at credit, we're looking at income, we're looking at assets. But we're not looking at it just to say approved, denied. We're looking at it to say, okay, look, these people want to buy. So can they buy now? Yes. How much? What are the different pros and cons? Could they get a better interest rate if they do X, Y, and Z to their credit reports? Or you know what? They can't get a loan right now, but they need to do A, B, and C before they can do it. And here's what they need to do in the next 6 months. And in 6 months, they can buy. So we want to put them on that plan to be able to buy. So it's all about advising the clients
Yeah.
and coming up with a structure that's specific to them, not just denied, approved. It's way more than that. Because if somebody wants to buy a house, I don't care if it's next month that they're buying or in 3 years. We want to help them get to that point where they can do that. And so we're going to go over that. We're going to answer those questions. We're going to then, if they are able to get conditionally approved, we're going to give them an estimate that is in writing to show maybe if there's only one program they qualify for or multiple programs to kind of show them pros and cons, different price points, different down payments and different options, and kind of give them recommendations and strategies for those different options based on what
Yeah.
our recommendations are. And then they're actually going to get out looking for a home. And if they find a specific home, hey, we may want to buy this one, we'll give them updated numbers based on that specific home. So my goal is that people are going to know what they're approved for, have a rough idea of what it's going to cost them. But when they find that home and before they even make an offer on it, they're going to have something in writing that says, hey, if I buy this home, this is what I'm looking at paying. This is what's going to cost me every month. And this is what it's going to cost me when I go to closing so that they know it without a question. I
Mhm.
don't want surprises. They don't
Yeah.
want surprises.
And surprisingly, I've run into this with some of my clients who have been working with you. They've come to me and they said, "Hey, David told me to sit tight." And is that something you can comment on? Just because I know that predicting interest rates isn't one of the things that people like to do on video, but
Sure. Well,
if
I
you
mean,
can,
I'm usually not telling people to sit tight on interest rates unless it's a situation where they can't buy something
mhm,
now. Because, look, from a supply demand situation, I don't care what the media is saying. There's no impetus, economically speaking, that's going to cause home values to drop significantly. So
yeah,
I still see positive economic appreciation in these homes, especially in our area. So given that, if you can buy now, even at a higher interest rate, and make 4, 5, 6, 7% appreciation over the next year, you're going to be better off doing that and then refinancing a year later when the rates come down, rather than sitting on the sidelines. If you can't afford a home, like if you're basically going to have to buy in West Virginia because you can't afford a home right now at the current interest rates, then yeah, let's give it a couple months. Let's see if we get some lower interest rates to maybe get
Mhm.
you into a home that meets more of your boxes, checks more of your boxes.
Yeah.
And that would be one of the only reasons I would tell them, unless they absolutely, they need credit, or sometimes I see people who just don't have as enough time on the job for like overtime commission or some secondary
Mhm.
employments. Sometimes they may have to sit on the sideline a little bit longer.
You commented on the economic stability. What factors do you kind of look at? Uh, is there something we should be watching?
Yeah. So when I look at home price appreciation and what's going on in the Federal Reserve, I mean, and just the economy is in general, I'm reading all the economic releases that are coming out. Existing home sales, new home sales, how many homes are being built, how many homes are being sold, how many people want to buy homes. Another big thing is something called family formation. It's how many people are basically leaving mom and dad and creating a new family. And that is the creation of demand, because if you have a new family, they need a new place to live. If they're still with mom and dad, there only needs to be one house for the whole family. So then all of a sudden now I have two, which is demand has been created. Whereas, if somebody leaves one house, whether it's a rental or they buy a bigger house, there's not been a difference in that demand, because they leave one house, they're buying another house, it's still one house.
Yeah.
So I look at all these different things to kind of determine what are we looking at in terms of supply of the housing, and what are we looking at in terms of the demand of the housing. So you'll hear things, economists and reports talking about housing inventory in terms of months of inventory. 6 months is kind of what economists say is a market neutral, balance of demand and supply, uh, months in inventory. Well, we're down around 4 months. And that actually also factors in homes that are under contract. And as
Yeah.
well as most buyers out there, you don't even look at the houses that are in contract because they're not available to you. Somebody's already
Yeah.
buying. It just means they haven't closed on them. So when you factor in houses already under contract, I mean, you're down to like 2 months or less of inventory. And it's just such little inventory. And I'm talking nationwide. So there are pockets where, inventory could be 7, 8 months. There are that could be like a month. So we're in an area that's going to be on the shorter end. So there's more competition. But because of that, that's really buoying those home values.
Mhm.
And that's why I don't see, a balloon. That's why I don't see like this collapse of home values right now.
Yeah. So how do you, I mean, I'm hearing you say some really like informed opinions. How do you get these opinions? I mean, if someone wanted to go do their own research, like what would you
Yeah.
recommend they should
Yeah. So the biggest problem is not necessarily getting the information and getting the research, because all this stuff is publicly available. I mean, you just go to, Google and look at any business, Fox Business, CNN, Yahoo News, and look at what are the economic reports that are released. And there's just a ton of economic reports from both housing and non-housing related things.
Yeah.
Um,
Those are some good resources, but one of the things I keep getting texts over is the every time a new thing comes up on in the news. For
mm,
example, the credit. I don't know if you've heard about this, where they're taking good credit to supplement bad credit. I mean,
oh, of course.
how much
Yeah.
stock should we put into news articles as opposed
No.
to like these
So
journals you were talking about?
I think we all know that, most news stories have some kind of a bent nowadays. It doesn't mean that the information's incorrect. It's just it usually has some kind of a
Yeah.
bias one way or the other. So, uh, what I was going to say to finish my previous thought about these reports is what you need somebody to kind of help you digest them through whatever
Oh,
lens that is.
100%.
So I didn't learn all this stuff just by taking classes. I learned most of it by reading it myself and trying to digest it and then seeing what happened from it. And then also by talking with people who have been doing this for
Mhm.
longer than me, and, now becoming the person who's been doing this for a long time and that people talk to and ask about what's doing. So again, I think my biggest goal is to become a trusted advisor with buyers and their agents and their family members and their referrals so that they can trust me to do the digestion. I mean, borrowers don't, some people want to understand all the minutia of this stuff, but most people say, I just want to buy a house and I want to get the best mortgage and I want somebody who's going to hold my hand through it. And that's why you work with an excellent real estate agent like you and why you work with a lender like me. It's because they want somebody to do it for them. I
Yeah.
mean, if this was easy, they wouldn't need us. There would be no job for us. It would be, Amazon.com real estate and mortgage, and they could do it all by themselves. But people still need us because not everything's easy. There are problems. There are things that come up, and people want to understand them. So going back to your question about the loan level pricing adjusters that came out from FHFA, the Federal Housing Finance Administration. So let's explain what that is. So
Yes,
back in
please.
2008, a law came out called Dodd-Frank. It was basically to protect and ensure that the financial meltdown that occurred then will never happen again. And two entities that really got hit badly during that meltdown were Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac basically got rolled under the umbrella of something called the Federal Housing Finance Agency, FHFA. And FHFA is the government agency that essentially runs Fannie Mae and Freddie Mac. On paper, Fannie Mae and Freddie Mac are private entities, but really they have to do whatever FHFA says. And Fannie and Freddie are buying most conventional loans. Basically, they're not buying or guaranteeing FHA, USDA, and VA loans, which are government loans. Those all go with Ginnie Mae, government loans. But they do all conventional loans, so basically not directly insured by or guaranteed by the government. They're buying or guaranteeing those. And that's a significant portion of the housing market out there. So what happens to them or what they do or changes they make affect many, many, many borrowers. So first thing, because of that, none of this stuff affects VA, FHA borrowers. So if you're a veteran buying home, your client's a veteran, it's not, these changes made no effect on them. But what they did is Fannie Mae and Freddie Mac basically say, look, because every borrower is different and every borrower has a different risk threat, profile, what we're going to do is we're going to basically create what we call loan level pricing adjusters. And what they do is they basically, for different risk thresholds, they increase or decrease the interest rate for borrowers. So Fannie and Freddie basically say, here's what the current interest rate, then you have to tack on these LLPAs to figure out what the actual interest rate is for that borrower. And the LLPAs are simply a grid. On one column, you've got FICO score. On the other column, or the other row, you've got loan to value. So, at one side, it's very low down payments, high loan to value. The other side, lots of down payment and low loan to value. And then you got high FICO scores and low FICO scores. So what happens is it was a grid. And you could say, okay, this borrower's got this FICO score and this down payment, so this is the loan level pricing adjuster. What they did is they reworked all these things and basically now it's still clear, like if you have bad FICO scores, you're going to get a worse interest rate because they're bigger LLPAs than the lower FICO score ones. But what they did is they increased the LLPAs for the people who are putting more money down and with higher FICO scores and increased much less the LLPAs for the higher LTV, lower FICO score borrowers. So what it did is they just made it a little more expensive for the better FICO score, stronger borrowers, and a little cheaper relative to the way it was before for the less strong borrowers. It isn't like they actually made it a better interest rate for lower FICO score borrowers. No, they're still getting a worse interest rate. Their interest rate wasn't worse as much as the better, stronger borrowers. So what this was, they said that they wanted to make it more affordable for basically less strong borrowers, but kind of the big thing that they missed, I don't know if it was intentional. I think it was probably intentional, but the big thing they missed is that these lower score borrowers, less down payment borrowers, were not getting approved for conventional financing anyways, because they're going to go to FHA, which is going to give them a better interest rate and better mortgage insurance because that's what it's designed for. It's supposed to be kind of the more subprime mortgage, and it would end up being cheaper. So the lower FICO score borrowers aren't going to take advantage of this anyway. So in essence, what that does is it leaves you with an increase in the LLPAs to stronger borrowers. And
Okay.
yeah,
So we
but
should be
it's really
excited
not going
about
to be that
this.
much. Um,
Is it going to
is
stay?
it any different than the government saying that they're increasing your taxes slightly? I mean, are you happy about that? No, but it happens.
Yeah.
So I would kind of be looking at it like that.
Okay. Yeah. I can see that being, like you were saying earlier with the slants that all these news places put onto it. It's been put out as this like, let me socialize the loan process, it doesn't necessarily sound like that when
This
you
is not the
put it out
first and
there.
this is not the last change that will be made by FHFA and the government on this. I mean, a couple of years ago, they increased the guarantee fee, which basically increased rates across the board. It's just anytime you got a lot of money and a lot of other people's money, think about how many times the government dips into Social Security fund. Social
Mm,
Security fund's not having problems necessarily because Social Security doesn't have enough money. It's because they keep dipping into the money.
yeah.
So it's just this is the life we have and the state of our country and the political environment we have.
All right. So as simple as you can make it, what do you think is going to happen with the rates over the next couple of months?
Got it. So next couple months to a year, I definitely believe firmly that there will be a decline in interest rates,
Okay.
especially over the summer, for a couple reasons I'll give you. First is that inflation is starting to decline. One of the biggest components of inflation is rents, housing related cost, owners, what we call owners equivalent rents. So about 43% of the consumer price index, which is one of the biggest inflation um, basically reports that comes out, is housing related. So the big thing about housing is it's a very lagging indicator. So when rents go up significantly, people have to enter into those leases and they're stuck in them for 12 months. But then as time goes on, they're starting to renew those leases at lower prices or not as high of prices. So what happens is if rent starts going down, a person may not realize it until they go to renew their lease or get a new lease a whole year later. So what we're now seeing is we saw rents go up huge a little over a year ago. And now we've seen rents decline slightly, actually not slightly, significantly, and it's catching up now in the report. So because we're seeing that, and you can see it from like apartment list reports and things like that on what the rental costs are, because of that decline, it's taken time for it to catch up. Another big thing is unemployment. So people think that a recession occurs, which again, a recession, when we have a recession, that's good for interest rates because the economy's contracting, inflation goes down, interest rates go down. So when we have a recession, that means that those lower rates, one thing about unemployment with a recession is that people think, oh, a recession occurs when lots of people are out of jobs. That's not true. That's actually when a recovery starts because when a lot of people are out of jobs and then they start to get jobs, things get better. But when unemployment is very, very low and everybody's got a job and there's virtually no unemployment and then things start to tick up and get worse, that's because people are losing their jobs and people no longer have those jobs. That's when we're entering into a recession. So we're seeing all those indicators. One of the biggest tried and true indicators of recession is an inversion of the yield curve. I won't get too much in the technicals, but it's basically like if you go to the bank and get a CD and you take a 2-year CD versus a 10-year CD, and that 2-year CD pays you a higher interest rate than the 10-year CD. You go, that doesn't make sense. Why would I ever do that? Well, that's basically an inversion of the yield curve, and it's indicative of a recession. So all these things are coming up, and we see these all very, very clear signs that recession is coming. And over the summer, a lot of the numbers that we replaced from a year ago, because when you look at an average, basically as every month goes on, it's eliminating 1 month from a year ago into that average. As we go forward, those months that are being lost were really bad inflation numbers. So when they get replaced, even with a moderate inflation number, it basically makes it look like inflation's dropping. And we're going to have every single report probably for the next 3 or 4 different reports throughout the summer showing that. So that's why I'm very, very bullish on interest rates in the short term and for the next year.
Okay, so if people are going to get ready, assuming it goes down, as you said,
Mm-hmm.
what would be the best way of preparing to do the refinance? They shouldn't go out and buy a Mercedes, right? We
No,
don't want
no,
them
they
to
don't
think
want to do
come.
that. They don't want to get any other mortgages on their mortgage yet until after they get their, so no home equity loans, home equity lines. We want to make sure we get the first mortgage taken care of first before they do that. They need to keep in contact with me. They need to talk to me. I get people calling me, monthly, every couple week basis saying, hey, is it time to do that refinance? And I'm clear in when I say yes and no, because I think that rates are going to be continuing to decline for a little while. I have a target kind of in the mid fours for stabilized 30-year fixed rates. And so I don't want somebody who's at 7.5 to then call me, oh, let's refinance. It's at 6%. And then, oh, it's 5%. Oh, keep refinancing and spend this money. No, let's try to get the one time so that's best for them and their family. But yes, communication with me. We are going to be proactive, but clearly, since everybody who bought a home or got a mortgage in the last 2 years is going to be refinancing, there's a lot of people. So we want to make sure that we address all of our clients and the people who have been loyal to us over the years first, and their referrals and the people they care about. So we're going to be trying to reach out to them as quickly as possible once we make a determination that it's the right time. But I'm happy to talk to anybody and give them my evaluation at any time.
And how do they get a hold of you?
Excellent question. So my website, davidbridges.com, has all my contact information on that.
Hmm.
They can call myself and they can call my office, talk to anybody on my team. They can also, on that website, is a way to schedule a meeting with me that connects right to my calendar, and they can just book a 15-minute time slot that works for them, hop on a brief call, go over everything, and then they can leave from there knowing a game plan.
Awesome. Well, David, you have the best hair in the family, and I really appreciate you being on and talking to my clients for me. I really
Thank you, Aaron.
appreciate you.
And thank you for trusting me with your clients.
All right, guys, that's fhmtg.com. When you get on there, David
davidbridges.com.
Bridges.
Yep,
And
davidbridges.com.
davidbridges.com will get you there, and then you can do your research. Is there any way they can look at reviews or?
Yeah, there's reviews on there. I got
Yeah,
reviews on Zillow. I got reviews on Google. I got reviews
he
everywhere.
is the man. All right, man. I appreciate it. We're signing off.
Thank you,
We
Aaron.
will talk to you guys soon.